Hello folks, and welcome to this adjusting entries video for some basic accounting, introductory accounting level adjusting entries. So let's jump into it, and what you see is we're dealing with a company called Isidore Inc. with a December 31st year end, and here are a few transactions that they've had this year. So we're going to, look at interest that accrues even if we haven't paid it. Two, we'll look at depreciation expense, especially in the first year of a new asset. And then third, we're going to look at how you calculate supplies expense at the end of the year. So we're going to try to keep it pretty simple. Okay, so let's start with number one, interest. On May 2nd, Isidore Inc. took out a loan of $100,000 with an interest rate of 6%, and there were no payments to the principal during the year. So we're just going to keep everything really simple. That's really all that is expected at the introductory accounting level. So let's solve number one. So what we're looking at is we need to create a calculation that takes the loan amount, the $100,000, times the annual interest rate of 6%, or 0.06 in decimals. So this here would give you the full year, 12 months worth of interest. We're not there yet though. So what I recommend is dividing all of that by 12. So we're calculating the monthly expense first. And then it becomes less confusing because then you can just say, well, how many months are we talking about in this particular year, the first year of the loan? And in this case, it's 8 months. Okay, so I'm just going to go back. You can see that we took the loan out May 2nd, so that's 8 months. And again, May 2nd, for our purposes in introductory accounting, that's May 1st as far as we're concerned. We're looking for you to round off to the nearest month. In reality, of course, there's daily compounded interest and all that. Those are a lot of moving parts. So if you see a date like May 2nd or this one July 30th, that's either the beginning of the month or the end of the month, and just go by full months. Okay, just to keep it simple. So that's where this 8 comes from, is the number of full months that we've had that loan. Okay, so if we type all those numbers in, so we're going to say equals $100,000 times the annual interest rate of 0.06, divide by 12 gives us our monthly interest expense, and then we're going to multiply by 8 because that's how many months we have, and you can see that we would have $4,000 of accrued interest expense, and that's what you see here for the journal entry. Interest expense debit of $4,000, interest payable credit of $4,000. Okay, that's how you do that one. Let's jump to number 2 now. So again, we've already talked about the date. So on July 30th, Isidore Inc. purchased equipment with a sticker price of $10,000 plus HST. Installation costs were $400 plus HST. That's value added tax. Useful life is estimated at 5 years with no salvage value, and then finally tells you to use straight line depreciation. That's what SL is. Okay, so let's look at how we would calculate that. I'm just going to shrink up the cell so we can pull what we're looking for here. Okay, so here's first how you get the amount of the asset itself. So I want to run through the definition of an asset for you. It's all costs involved to get an asset ready for the company's use. Okay, so back over here, it starts with the sticker price, but you have to add any sales tax you paid. And you also have to add in, oops, sorry about that. You also have to add in any installation fees, any costs that were involved in getting the asset up and ready for your use. Okay, so there's the $10,000 plus, let's say, 13% HST is $11,300. The $400 installation cost, and that has taxes on it as well, so $452. So our total asset is $11,752. Okay, and just like up here when I said calculate the monthly expense first, I recommend it for assets as well. So if you divide by 5 years of the asset, that's 60 months worth, and then you will get what your monthly amount of depreciation is. So what we'll do is we'll say the debit for this year equals the total amount of the asset divided by the 60 that we see here, and then we need to do it for the number of months in the fiscal year. And because this was the end of July, that would be 5 months of this fiscal year. And there is what we get. Recommend getting rid of decimals, okay, for basic accounting. So there we go. Don't worry about the pennies. And that would be full marks entry there for the depreciation question. And then the final question was supplies expense. So you see this a lot on introductory exams. So let's say that supplies had an opening balance of $700. This, I'm going to scroll over a bit here. Purchases during the year were $500 and the ending balance was $1,000. Okay, so let's look at how we would go about calculating that. So 700, 500, and 1,000 are our numbers. So highly recommended is to set up a basic T account to do this. Okay, and you can see we had our opening balance of 700, that was given to us. Purchases, which are always a debit, of 500, and then we know we had an ending balance of $1,000. We were told that. These are all in the debit column, you can see. So the question then becomes, what credit do we need to make all of this true? To make these debits matched with some level of credit equal an ending balance of $1,000. And you can use some quick, oops, sorry about that. You can use some quick algebra to calculate that. Really what you're doing is you're adding these two and subtracting this one. So just to keep it simple, I'm just going to type in the $200 that it is, okay? But just make sure you put in the right credit amount. So there's your credit for what will be the journal entry, a credit to office supplies of 200, and then a debit over here to office supplies expense of 200. Okay, so that's what we're going to do over here. So we know now, I'll just grab it from the other sheet because I always recommend that to students, is to grab numbers from a different sheet, because then if you update one sheet, the other will update for you. Okay, so there's our debit. Okay, and then for credits for these types of journal entries, I always just recommend hitting the equals sign and then grabbing what the debit was, because then you know your debits will equal your credits. So that is a look at 3 types of adjusting entries. I hope this video has been useful to you. Keep working hard at this.